Should we get cracking? Good afternoon, everyone, and welcome to Taking Stock After the Bell, episode 18, if I'm not mistaken. We're delighted to be joined today by James Hughes, investment manager at Commodities, who's dressed up for the occasion.
I got really excited then because I thought we were delighted to be joined by Jamie, and then you said me, and I was like, that's good.
We're even more delighted to be joined by Jamie Maddock. Jamie, good afternoon. Jamie is Commodities' Global Energy and Materials Research Analyst. He analyses companies and industries and generates investment ideas by incorporating an in-depth fundamental understanding of macroeconomic drivers and commodity supply-demand balances. Mm-hmm. Jamie joined Commodities in 2021, has over 10 years of research and investing experience. He's worked at buy and sell side firms including AGF Investments in Canada, no less, Deutsche Bank and Morgan Stanley in London. Jamie earned a BSc in Geology and Petroleum Geology from the University of Aberdeen.
Yeah, oh, there we are.
Followed by a Doctor of Philosophy in Geophysics from Leeds, and I can't even say it. In addition to being an avid traveller, Jamie enjoys country pursuits, spending time with friends and helping out on a family farm. Sounds like a dating website. Jamie, pleasure to have you.
Thank you. I mean, you got this off his Tinder profile.
Well, I must have done. I mean, that's extraordinary, isn't it? But how are you doing?
Oh, all right, thank you. Yeah, no, thanks
for
having me on.
So in the teeth of it?
Just starting, yeah. Energy stocks have just Total today. That's the first of them. I guess we're right. Mm-hmm. And then materials companies haven't started coming out yet. So we've had the production output updates coming out. Mm-hmm. They've, but nothing, not earnings wise as yet though. So,
what's the most satisfying bit about your job as a research analyst, and what do you think is the most challenging or least rewarding?
The most satisfying is, complexity intertwined with, what's the best way of putting it? The information you can take from covering one sector or one stock and transferring it across to learn or to try and have greater insight about others. It's sort of people always talk about this in the finance industry, right? About constantly evolving markets and things they have to deal with. And I think that is definitely true. Yeah. I'm fortunate enough as well as they're both macro sectors. Yeah. So it's, by implication, a lot of people are always interested in it. It's good to be involved in discussion and debate about it. And the more people challenge and contest you on your view, it sort of helps to refine your own view and your own understanding. So it's super interesting. But
you got sort of something called a mosaic theory, isn't it? Where you build a picture of something with little different pieces of information, and then you put all those pieces of information together, and it you get a picture, a fuller picture. And I quite like that, particularly in across your sectors, which are sort of intertwined. You're right. You can pick up a lot.
And I often actually see greater. You would think that doing the academic background that I have, you wouldn't necessarily think, well, how does that apply to finance, economics, and investing? But actually, geology at its heart is effectively mapping, and it's taking disparate observations and trying to interpolate, so join them up and interpret what those things say. So if you go to Scotland, you might see a hill, but you got to understand, well, you don't see all the hill, but you see bits of the rock exposure. So what is it that's behind all that? And more or less, that's what I do on a day-to-day basis. It only occurred to me relatively recently that, there's actually a strong degree of similarity and crossover with my education. So, but at the same time, of course, that makes it super challenging because of the degrees of complexity and the I guess a lot of analysts would say this, but when you have the micro and the macro interacting, there's a lot of cross currents and things that can affect a stock price move in any individual day, and I think that's maybe the same. But
at QC, you obviously tend to look at the larger oil and gas and material businesses, and they're obviously more influenced by the macro than smaller companies, and also see the resources there. It's about cash control. It's less about exploration. It's more about controlling margins and in reality refining everything. Have you spent any of your career looking at kind of more of the micro, small cap type companies around exploration? And do you find that more exciting or more interesting? More, I guess it's with a lot of it, it's that in the air, and are they going to find something or not?
Yeah, so like as a junior analyst, when you come into energy, that's more or less what you're assigned the task of doing. So that's kind of what I did. That's where I guess got my grounding in it, and effectively. So you end up valuing a company and then a bunch of options. And again, I guess it's drawing upon the expertise that I had from my university education. That sort of company, that education is actually quite useful in discussion with management, because they're so often used to having a discussion with like an economics or whatever it might be, statistics, educated
no
person.
idea about the geology or the ground that we've got here is suitable for oil because and you actually do understand that.
It's like, I don't think they mean to do it, but they'll bring up a seismic cross section. So this is like, they take the data, and they give some sort of image of the subsurface, and they will say quite convincingly, we're going to drill here because we think this is the target spot and we think it's going to be oil. But you can easily challenge that and go, well, actually, it could easily be fizzy water. They would give you the same seismic response.
I always like a smaller company announcement of we found hydrocarbons, but unfortunately, it's more the type that you can drink as opposed to the stuff that you go in your car.
Well,
I find it really interesting because we talked about this before, but when I started my career in 2004, oil and gas and mining was a sexy place to be.
All the rage.
It wasn't, and you'd have management teams coming in, and they had these seismic charts, and they show where you're drilling, and you'd be like, looks very colourful. That's great.
Take my money, take it now.
I know. And the nodding donkeys, the tiny little oil producing. I went on a field trip once to.
You're really buying into it then.
To Trinidad.
Yeah.
No
wow.
way.
Yeah, I won't mention the company.
That was
we
bull
saw
market
some
stuff.
nodding donkeys and we went into the woods somewhere. Sounds a bit dodgy, this, but we could see the oil seeping from the ground. And stuff.
Yeah.
Amazing.
Yeah, so it was. I shouldn't have been on the field trip, but it was absolutely fascinating. I loved it. But my knowledge of oil and gas is not. Is not. I'm better off listening to what you tell me.
No. Sometimes it's as well not knowing, right, and then just near on flipping a coin. I mean, if management were so insightful at their ability to strike oil more than a greater probability, they wouldn't
be
have the success or lack thereof.
Wouldn't be chasing you for cash in the first place. Would they?
Yeah, exactly.
Wouldn't be doing it in the
But
first
it's
place.
funny to that point though. It was classic pre-2014 oil discovery, technical success, but not commercial.
Yeah.
Another way of saying we found some, but really not worth spending any time here.
Falkland Islands.
Yeah.
I mean, they had rock copper and
Borders,
Falkland
all
oil
of
and
them.
gas. Actually, the business I work for listed Falkland oil and gas.
Is that right?
Yeah.
Amazing. Well, it's good to have you on, Jamie. And part of the reason we thought you'd have you on is not just because we think you've got some interesting things to say, but last time around we had Dario Perkins from TS Lombard on, and we sort of talked about potentially going into a more inflationary environment, and he used the phrase tangible 20s, which we used before, to be fair, and it's been a bit of a theme. And I guess commodities might sort of fit the bill, and this is definitely not a prediction for the next decade, but it's certainly something to think about. And I sort of just start us off with the Bloomberg Commodity Index going back 30 odd years or so, which we've just put up there now, and we can see that basically over 30 years, broad index of commodities has gone absolutely nowhere. And we can see these spikes. There's a big spike clearly in the good old days that Husey was talking about, the 2004 to 2007 commodities boom, and then the crisis and the crash, and then actually quite a strong recovery in the early 10s, and then the 10 years to the pandemic really. Commodities was an absolutely dire place to be. Commodities are pretty cyclical, and I've got this diagram here which you sent, which I think, I'm a farmer's son, and this absolutely resonates with me. So, low commodity prices in a classic cycle, depressed valuations, supply cuts happen, supply comes out of the market, the price goes up again, valuations go up, and then people throw money at it, which, so what's the famous phrase? The cure for high prices in commodities is high prices.
Yeah.
And that's what this kind of graphic here attempts to illustrate. So, I mean, where do you sort of think we are in the cycle, and do you think, perhaps as Dario sort of alluded to, that we might be entering into a slightly better era for for commodities?
Yeah.
Just to start you off with the softball question.
Yeah. If you just go for on the prior chart of that cycle, I mean, the high commodity prices, I think you could assign to a few of the what constituents of the index that you've shown there. I mean, but not for the large majority of them, though that wouldn't be the case. So you're somewhere round about there. We're past the point of supply getting taken offline, at least. So when I'm talking about this, I'm talking about both metals and this sort like oil and gas and things. So we're not really in the supply cut territory at the moment, but equally we're not really in a high commodity and price environment for everything in there.
Yeah.
And certainly not elevated.
Yeah, I was going to say,
and especially if we inflation adjust the oil price or base metals prices, they are much cheaper than they've been for years, right?
Even if you were to cut the current commodity prices, let's assume they were high, and look at the implied valuations, they are not high either. Mm-hmm. So that's another way of just saying, are we in an environment that we're sort of missing by assuming what is today's prices are relatively low. But so actually, so I mean, we're still in that territory. I mean,
so if we look at the sort of the geopolitics and the macro, which you sort of touched upon at the start as being part of the job, can you sort of envisage an environment where we get structurally higher inflation, more supply shocks, more volatility in commodity prices? I mean, when I say volatility, I mean them going up because war in the Middle East. And we'll come on and talk about oil and gas shortly, but weather events, climate change, Russia, Ukraine, these things seem to be coming along. Well, they have come along more frequently in the last few years, but is that going to be a theme of the next 10 years, do you think?
Yeah, I mean, so where that is, I guess, putting softs aside, because they tend to move with their own cycle, and probably softs and fertilizers would both fall into that camp because they're in a different cycle. Sure. But certainly, the energy transition as a backdrop and what it's meaning for the supply side impact on the conventional fossil fuels like oil and gas, and at the same time the metal side with respect to the demand that's been driven, the interaction of that theme of the energy transition on both of those components and the transition from one to the other is undoubtedly going to lead to continued volatility, I would say, because I mean, we have this situation at the moment whereby we're forcing companies, the traditional energy companies, to restrict their supply, and we've been doing that via the mechanism of driving their share prices down, and everyone just eschews them because they're bad businesses for such a long time and they've lost shareholders such a lot of money. But at the same time, whilst we're investing into the energy transition with respect to things like our electrification of our transportation, we're not doing enough yet to offset the decline. So whilst more money is going into it, the energy being added is just not sufficient. So there's always going to be these, I guess things are going to be out of balance, but it's particularly difficult because of this rapidity of the supply shock that has been felt within the fossil side, at least. We just don't have the renewable energy in the system to counterbalance that. Yeah. We don't have enough spare capacity built up. We don't have enough
resilience, isn't it?
Exactly,
That's the big issue.
Even if there were to be the utilization of renewables in the sense of how windy it is or how sunny it is goes up and down such a lot, we need to have sufficient counterbalancing energy in the mix to make up for that, to prevent quite excessive volatility in price, and we're just not there yet.
Well, we'll talk a bit about energy transition a bit later on, but I mean, let's start with oil and gas and fossil fuel energy. It's a long-term chart of the oil price, also 30 years or so, and the 90s, it was flat, calm in the $20-$25 range, bit of a blip in the Kuwait war, and then it sort of, the noughties, as we alluded to, the oil price went up to $150, and Goldman Sachs famously forecast the $200 oil, which I think was the day it peaked. This was back in the days of the sort of the BRICS and China building 20 cities the size of Chicago and all that sort of stuff. And then, of course, the financial crisis came, the oil price collapsed before kind of recovering quite strongly, actually. But then since then, oil prices have drifted back a bit, haven't they? With the exception of the Ukraine war, and then they dropped back quite strongly last year. Before, more recently, we've had a pretty strong uptick in the oil price actually. So why don't we sort of start with the Middle East, because I think that's kind of top of everyone's list of worries at the moment, is what's happening in Israel and Gaza. As shocking as it might be, is there a concern really that this is, the oil price has gone up a bit on Middle Eastern war fears, as it often does?
Yeah.
Are those fears justified, and why might those fears be justified?
I mean, certainly there's a premium in the oil price reflected as a result of the risks in the region. There are, and I guess why is the premium gone in there? It's because something similar to this happened 50 years ago, more or less to the day, with the Yom Kippur War, where oil prices tripled on the back of that. Now, the difference between now versus then, beyond it escalating and expanding into other regions fairly swiftly, is that OPEC's spare capacity back then was very limited. And that's the biggest difference to where we are now, is that OPEC's spare capacity is in fact quite large in comparison.
We've got a chart here, in fact, of OPEC spare capacity, which is the blue bars, isn't it? And we can see that it's relatively high compared to where it's been historically.
Yeah, and certainly relative to where it was 50 years ago. So I guess all it's to say is that there is reason to be concerned because of where it is with respect to the Middle East, where the war is in the Middle East, so a lot of oil supply comes out of there. But the ability for Saudi and OPEC more broadly to respond to an escalating crisis is there. They
because
have the
OPEC
buffer.
sort of lost control of the oil price a few years ago, didn't they? But actually today, I mean, you're the expert, you'll know more than me, but it feels more recently they sort of grabbed the bull by the horns again and seem to be controlling. I mean, they have before the Middle East, disaster has happened. They were cutting supply. And they'd actually already started pushing the price up, hadn't they? And then you obviously had the US government coming out saying they were going to refill some of the reserves, which they said they were going to do a long time before. And then what actually surprised me was the price was much lower and they said nothing. Yeah. And then obviously Saudi came along restricting, and they've decided to try and refill at a higher level, which it's like trying to fill the bottom of the market. It does feel they've got more control over the price than they've had. Yeah, definitely. Which is interesting.
And their action has been really the sole reason for the price. Prior to what happened more recently, more or less Saudi's actions alone was the reason for the way the price is traded this year. So you're right, they have wrestled control. And the thing that we haven't, and that chart of the sort of long-term oil price chart, the thing that's changed to allow that to happen is shale oil producers, which were basically the marginal supply that was growing rapidly through that period whereby it kind of trended sideways. US oil supply was growing at 2 million barrels a year. So that period there, it was easily outgrowing global oil demand growth. And then at the point where it tipped over, of course, is when,
my understanding of why that's not coming back on stream is because of syndication of banks. Essentially, there's not as much debt being, or basically, traditionally, a bank syndication, you might have 9 banks in there. And because of ESG reasons, you might only have 3 or 4, and they can't get the same level of debt. Is that right?
For sure. Yeah. And of course, CEOs are compensated, and more so in the States than here. A large part of the remuneration is share-based. So, oil price collapses on rapidly growing supply and lacking demand, stock price goes down. I mean, what's the thing you start doing? You start having to ask shareholders, what is it you want? And the thing they ask for after the 3 years is discipline. And more or less, the response in the oil price is that discipline coming through. So to bring this chart back up, supply started getting taken off. And where are we now? It's that they are being, what's the best words?
They're being relatively disciplined now, aren't they?
What I was going to say was management are being rewarded for that discipline by higher share prices, and they obviously share in that benefit from their stock price appreciation and the benefits they see. So whilst it was during that period when China was growing very rapidly and they're being rewarded for bringing barrels to the market, and they were basically spending more than their cash flow, organic cash flow was generating. They were bringing in. So to the point that you were saying about banks, yeah, I mean, they were basically drawing on bank capital and equity raisings, like we're talking about the E&P territory, to grow supply as fast as possible because that's the way they were compensated. So the discipline that has been instilled upon them because, well, banks have withdrawn, share prices collapsed, and that's more or less the response we've seen there. More recently, we've probably moved from that environment, and whilst that discipline is still there, the two things which are interesting is, despite that very sharp oil price rally, activity has lagged that, so we haven't gone back to old behaviors yet. So the correlation between response and activity and oil prices is not there. But also there's now questions on whether the quality of onshore oil reserves are there in the States.
Right.
As in, like, can we ever go back to the speed of growth that we had back then? One, is the oil field service industry there large enough? Because it, of course, got sized to pieces through the drawdown that you saw in the oil price because everyone withdrew activity and tried to survive. But also, so there's that component, just the pure service capacity, but also just is the quality of reservoir and rock there to get back to the rates of growth and supply that we had. And I think now there's more emerging evidence suggests that we probably can't get back to that again.
Okay. Because shale oil in the States is quite a dirty business, right? So correct me if I'm wrong, but they take basically a big pipe of water and they inject the water at high pressure with sand.
Yeah.
Is that right?
Yeah.
And then they kind of blow the hole out with high pressure water to
Yeah,
get the oil out.
pretty
And
much.
it's quite a dirty business, quite high energy. It's not.
Yeah.
It's not environmentally friendly by any stretch.
No.
And that's the reason for a lot of in the UK why we've not gone down the route of looking for shale oil is because of the potential environmental in a much more crowded island. It's not anywhere near as friendly, I suppose, is the right phrase.
I think the scale of America is often underappreciated by Brits.
Massively.
And I remember overlaying the well density they have in America on the UK, and it's just like Yorkshire, Lancashire, gone. It's just like peppered with well, because people don't really appreciate they're not that far apart, and they go for kilometers beneath the surface horizontally. I mean, and there's just thousands of them being drilled. I mean, it's like at its peak there was hundreds of rigs drilling thousands of wells a year. Like there'd be nothing left. No, I mean it's just. That's not like a political statement. That's pure, just the rational fact of our roads couldn't physically carry the materials required in order to bring the 10,000 gallons of water that are needed to a well site.
Amazing. So, I mean, in terms of the oil price, what are the sort of short-term drivers in your view? We talked a bit about supply and OPEC. On the demand side, we've got potential for Western recession. Recession generally is all negative, but then you've got China coming back as well. So, what are the sort of bull and bear cases in the market at the moment?
If we talk about the supply side, and what might happen in the Middle East and how that might broaden out and the impact that might have to other supply getting taken off. But on the demand side, all year you've more or less seen demand soften. And that's a primary reason why we've seen Saudi respond as the way they have to basically offset the impact of that softening. But you're right. I mean, as the Western world has softened, China more or less is grown. So all the demand growth that we're seeing this year pretty much is China led. Right. And that's mostly just jets flying around, people traveling more. So
not to put you on the spot, what proportion of oil is used for planes flying? I mean, do you know what the split is of oil? Where does
not
oil
off the top
go?
of my head. No. But I'm just saying in the context of like where the growth is coming from, it's like
change, it's the delta. It's all word the finances use. Isn't it? Everyone knows the delta.
It comes entirely from that.
Yeah. But it's interesting is because when we have a recession, we stop going on holiday, we stop flying on planes.
Yeah.
And that's the marginal demand, and that's why the oil price in 2007, pretty much collapsed, as well as in 2000. In 2000 is the more obvious reason.
Yeah.
We stopped going anywhere, and the oil price. Talk us through the fateful day in April 2020 when the oil price went negative. You were paying people to take oil off your hands. Incredible, isn't it?
Yeah. I still got a picture of that.
And if we, and then one more.
And I would just say on that, like in the context of where we were this year, like we came into the year with high expectations about China against the backdrop. I think everybody thought that the rate of interest rates going up would inevitably, fairly swiftly translate into economic slowdown. And it was pretty quick. You could see in the data pretty quickly that there was having some emerging impact. So I actually came into the year and basically end maybe from September of last year to coming into this year fairly bearishly viewing the energy
Everyone was
sector.
bearish this time last year.
And so the demand was a little bit soft in the Western world. We hadn't really seen China picking up. Not just that, but when China did come back, it didn't really come back in a way, which is in hindsight is maybe not that surprising, because much like when our restrictions got removed, we weren't just straight out there. It was a bit of this stop-start and going to the world. And then more or less that bearishness was overwhelmed by the simple fact of Saudi coming in, saying we're going to take 2 million barrels off the market and offset that slowdown. So it's really completely changed where we were from the start of the year versus now. Yet the demand backdrop more or less remains the same, but yet the supply picture has been completely changed by the single, and to your point, the wrestle control of the market away from the other producers.
Yeah.
And then moving close to home, Jamie, we've got, the story of the last 2 years in the UK has been about gas prices and about our energy bills, and we're seeing now as we go into this winter, despite UK gas prices being lower, we're actually going to end up paying more energy bills this winter because we've lost the government subsidy. Now we've got a 2-year chart of UK natural gas, which is essentially what the power stations pay for marginal energy, if I'm not mistaken. And we can see pre-war it was about $80 pounds a therm. Is it a therm?
Usually.
Is
that what you have there?
I think so, yeah. And then we can see clearly in September last year that spiked to over £600 a therm as kind of Russia turned the taps off. And historically we in the UK have not really future-proofed our kind of storage of natural gas and things, to be slightly controversial about it. I mean, the natural gas price did collapse over the last 9-12 months. However, it has sort of ticked back up again. What are we likely to see this winter in terms of gas prices? Are we going to see another spike? Do we have enough gas to see us through the winter? What if our friend in Russia decides to turn the taps off again? Is that a risk, a real risk for us, or just a kind of potential outlier?
I mean, I don't think we'll see what we saw back then again. One, the dependence upon Russia is substantially reduced, and there's greater, I guess, preparation for defending against that.
We're pretty much full storage, aren't we?
Yeah, across Europe. The issue, though, is this is all weather dependent.
Yeah.
We have so to the point on storage, we're pretty much there, but we can deplete that very quickly were it to be a cold winter.
Yeah, we were bailed out by last winter by having a really mild winter, right?
Yeah.
And particularly in Europe, they didn't have many cold snaps at all, and storage held up really well.
Yeah. I mean, industrial activity last year and this year is down quite a lot, so it's the industrial output side is, I guess, reflecting the higher prices by just doing less. It just amazes me how little attention is given to us doing more. Like, that never seems to be a discussion point. Like last year, it seemed odd that we were never compensated for a reduction in usage, because that's ultimately the easiest way to mitigate those price spikes. But we were basically just given more money to use the same amount of power.
And
as
I
we
think
wanted.
I read some of the Germans used 20% less energy domestically, which is a huge number for every household to use 20% less. But there was never.
I thought the UK used.
We use a bit less, but that was mainly a price mechanism thing. Like, there was no, if you think about it, there was no advertising campaign by the government saying stick your woolly gloves on.
Yeah.
This is how you cope. Like, we didn't drive that message home like they did in Europe in particular.
Yeah, I mean,
because it's a sort of quasi war effort, isn't it? It's almost rationing.
Yeah, I mean, my wife works for a German investment bank, and I know in Germany they turned off things like the water features, and
they did a lot,
and everyone had to leave work at. Maybe historically the lights were on all night, which I get, is a complete waste of energy. But they said 6:30 everything's turned off, and I think they've carried on doing it actually.
Good idea. I mean, the thing is, as well, a striking difference 2 degrees can make on your thermostat.
Yeah.
If the whole of the country decided,
you can go from being really comfortable to bloody freezing.
It's grand. Well,
I mean,
depends.
mine's set at 17 and it is freezing.
Okay, maybe you can't lower yours too.
It's like meeting room 7 in here, isn't it? It's
23 to 21.
100% is 2 degrees. I mean, if anyone has their house at 23, that is hot.
Money to burn.
But yeah, so
Johnny's got it at 25. He walks around in his swim shorts, isn't he?
That picture can change pretty swiftly on the back of a pretty cold winter. We don't have the sufficient storage.
Are we building storage?
Compensate? Not to my knowledge, no.
No, because we got rid of all our storage.
That would be
20 years ago.
forward thinking.
Yeah. Okay. We stay
Can't
away
do
from
that.
And more or less, they tried to deliver an energy transition whilst being entirely dependent on cheap gas piped in from a potential adversary at the same time.
That's
so,
a take. That is a take.
I mean,
isn't it? That is the planning at its finest.
I mean, a year ago, almost every conversation was around starting up nuclear again, and that seems to, those conversations have finished again.
The Rolls-Royce modular
Yeah.
reactors. Yeah, you're right.
it's a key component of any energy transition solution,
Has to
but
be.
doesn't.
Fusion was written about in almost every paper every weekend. It's but it's amazing what sort of the oil price falling and energy prices getting cheaper does. People lose interest very quickly, don't they?
And we talked about some of the oil majors. I mean, I'm sort of moving on to the sort of some of the oil majors, and BP and Shell sit close to our hearts because they're two of the biggest stocks in the UK market, and we love the dear old FTSE on this podcast, don't we, Husey?
Massively undervalued.
And we've got a 30-year chart of the
future.
global energy sector. So these are the all of the oil and gas stocks globally. So BP, Shell, Total, Chevron, Exxon, etc., etc. And what we can see clearly through the 90s and the noughties was how well they did, and then since 2010 they essentially went nowhere. And this is total return, so this includes dividends. Until recently, where we've had a bit of a leg up post-pandemic. So it's been a pretty tough period to be, over 30 years, investors have broadly done well investing in oil and gas.
Yeah.
But they had to endure a lost decade and a half, right? Until the last few. How was it being an oil and gas analyst during the 10s?
No, it depends which part of the 10s you're talking about. It was either trips to Kenya and Mauritius to see potential exploration hotspots, and the first part, and the latter part was major cutbacks.
And was that, obviously you were sell side then. Was that sort of doing research to sell, or was that on the M&A and kind of IPO side of things?
A lot of it was around fundraising opportunities with respect to expanding drilling campaign programs. Instead of doing 10 wells, we'll try have a crack at 30
So
and
you were
open new
colouring in the geology
frontiers.
maps going, look at this is amazing. Look at this oil.
I mean, a couple of our colleagues got well and truly sucked into, I think it was Bahamas Petroleum.
I just wondered how long it'd be before that came up. Yeah. And
it's changed its name again, and I think it's probably become some crypto. It's probably crypto for a bit, and now now it's probably an AI business, I suspect.
Yeah,
isn't that Bankman Fried's place?
That's right.
True.
But no, it was dire, and I mean the share price chart that tracked sideways was just reflective of the fact that they weren't making money above their cost of capital to return to shareholders. They were using debt to pay dividends to shareholders that demanded it, but yet they had businesses which were outspending the cash that they were generating, and rightly so, they track sideways.
But the last 3 years been a bit different, isn't it? And we have seen some good returns from the sector, particularly in 2022 when pretty much everything was going down. The energy sector was kind of the only place to be, really. And we've got a slightly busy chart here about what the majors are doing. But I guess to come back to your point about what were they doing during the 10s, we can see that the bottom 2 or 3 bits of that chart are basically dividends and buybacks, and the middle block in blue, the big block in the middle is capital expenditure. And anything I guess that's notable for me is how in the last 10 years the level of capital expenditure has fallen pretty drastically. As we talked about with the cycle, when prices go down and valuations go down, people stop investing, and chief execs are more incentivized to kind of strengthen the balance sheet and not go searching for new oil. So I guess the question here is there a risk that the absence of capex in the last 5 or 10 years is sowing the seeds of the next shortage? Is that a real concern in your view on a medium-term basis?
It's funny because that was... This is not going to be hugely helpful, but originally, when the first downturn happened, it was anticipated that the fall off in supply would be pretty rapid, and it hasn't really been the case. Right. We've found they've found using less money. Another way of saying it, being more efficient, right? They've used less money to do just as much as they were before. So
I presume it's been like massive deflation as well.
Yeah,
so
well, that's right. So I mean, like
$10 million can buy a few more rigs.
Yeah, exactly. And the rigs that were priced at premium and were more efficient are now half the price on a per day basis, so you kind of get more, and that's right now. I mean, that's probably that case just now. I mean, I would say that America, like I say, in the US onshore, it's more or less run out of all those efficiency gains.
Yeah.
So the gains you're seeing now were probably more on the cost side. It's difficult to disaggregate the contribution from it, but a lot of companies were talking about the benefit of digital, the ability to sort of increase operational efficiency.
Are they using AI as a...
Well, no.
They were using digital twins, weren't they?
To try and...
Which was super interesting.
And to try and, like, before, this is ridiculous as it sounds, but before it was different companies would have different paints for their rigs, for their platforms, and they would use, the nut would be X mil that this engineer would use, and the BP engineer would use a different nut. And it's all about sort of industrialization of manufacturing now. And
I love that stuff.
That's
really interesting.
They're more or less trying to take what they had on US onshore and use it for these larger projects, which are typically done by the majors. And so I think that's probably the reason why we've still not seen this rapid fall off. But that's got to be in the background, though, the thing. And it is something that we're always cognizant of, that as the sort of the reallocation of capital, you've got to be storing up problems. And
has Saudi not just not got so much oil that they're always able to supply into it?
Yeah.
How much oil do they have? Can they go another 50 years, 100 years?
Yeah, I mean, they've got ample. They will be the last man standing.
But we're not at peak oil demand yet, are we?
So the latest IEA estimates, so IEA, International Energy Agency, they say 2030s. But the thing that I would say is that, like, people hear the word peak and they think alpine.
Yeah. Oh, yeah.
But it's like peak like this.
Table
sort of,
Table Mountain.
Yeah, that's exactly right. So, to have the word peak and peak oil and peak demand, it sort of misses the point about where I'm probably going to have peak and bumping along ups and downs for a good number of years yet.
But I mean, it's interesting if you're Saudi, if you've got a super long time horizon and you've got loads of oil that's enough to last 50 or 100 years, and your wealth is reliant on that oil day to day as well as long term. If everyone is telling you that we need to stop burning fossil fuels because of climate change, and at some point we are going to transition, we'll come on to talk about transition, we'll transition away from fossil fuels. Therefore, your fossil fuels are going to be essentially valueless at a point in the future because we're not going to be using them anymore. Yeah. So, the sort of thing that slightly surprises me in a way is that, well, if we need to sell as much as we can now even at any price, because we're better off selling it at $10 a barrel. We're better off selling 100 million barrels at 10 than we are selling naught at 100 or whatever.
But they definitely do that balance. I mean, at the moment, I would certainly, Russia is better off now, even by supplying less than it was last year, because the prices are high. And I'm almost certain that Saudi thinks about, probably not on the 100-year view, but I'm guessing they think on a 3 to 5 year view. How do we think about using the levers of price and volume to maximize return? But it often maybe doesn't, but look at the things that they're doing to reinvest in their country. The footballers that they're bringing over there, they have oodles of cash, and they are taking it seriously. Like, I think, they are investing heavily into their own economies because they are mindful about this.
Mindful of transitioning.
And many of the things that they've done, so listing Saudi Aramco, and there's been pipeline companies that they are monetizing their fossil fuel oriented in a public market setting. So,
and Saudi Aramco is the third biggest company in the world?
Some of it is now, right?
Second or third?
Yeah, it was
Apple and Microsoft, I think are bigger in market cap. Saudi Aramco is
it's very, very small, so their free float of Aramco is tiny. Yeah, they're not blind to it, I don't think, and you could have a laugh about whether you think getting footballers over there is the right thing to do, but they're
well, if that fails, they've got the golf, haven't they?
So and they're going to build this. They're holding the Asia Winter Olympics there.
No way.
Yeah. They're going to build
There's a lot of sports washing going on.
The ski slope and whatnot.
That's for another day. And then I guess the other sort of hot story as far as the oil and gas majors are concerned, and we've been talking about BP in our morning meetings and things for a few months. So BP looks a little bit rudderless, got no chief exec after the issues a few weeks ago. It's sort of, and and we sort of maybe thought that maybe Chevron or Exxon might think that might be useful, but we have seen some pretty chunky M&A in October alone. So the two headlines here up on the slide: ExxonMobil agrees to buy Shell Group Pioneer in $59.5 billion. That's quite a big deal. And then 2 weeks later, or even a week later, Chevron to buy US oil producer Hess for $53 billion. So some pretty chunky deals going through. Does this surprise you? I mean, cost of money has gone up quite a lot.
Yeah.
Cost of debt's gone up. Then clearly they're not spending it on exploring capex for finding new oil. Is buying Hess and Pioneer cheaper than looking for more oil themselves?
That's a good question. We used to think about that when we were thinking about the E&Ps, basically like per barrel acquisition cost versus finding and development cost. I mean, what's interesting about both, so both these deals were done with shares. Both were all share deals. I think that was kind of helpful, at least, to thinking
Massively.
we're not moving into that final.
Last hurrah.
Because M&A does, when you've got oil at near on 100, does feel a bit toppy.
Feels a bit toppy. Yeah.
But when they're using shares and not much of a premium, and when you look at both the company's valuations and the targets of the acquirers and to be acquired valuations, they're not high valuations. Or you can maybe argue, okay, well, the oil price is a bit elevated, and therefore the valuation they're paying is a little bit higher. But
they're paying in shares. It's not that important. I always sort of remember being told that Vodafone did a lot of M&A in the 90s, and obviously the share price went kind of mental.
Yeah.
But all the deals they did was in stock, so they never pay cash.
Yeah.
Which is why the company is still going. Admittedly, the share price is nowhere near back to where it was. But the flip side of that is that Royal Bank of Scotland, in its prime, paid cash for ABN AMRO, which killed it basically.
Yeah.
Well, it would have died anyway. But so that's kind of encouraging to see in a way. But on the UK majors, BP and Shell in particular, would you be shocked if anything came along for them? I mean, Chevron and Exxon, clearly the two big players, so presumably they're done for M&A for the time being.
I mean, what's interesting is that divergence, right, between US and European majors. Both the US majors have made it pretty clear they're not interested in an European-style acquisition in the context of energy transition or anything like that. They're both pure play oil producers. That they've gone for Exxon's gone for an onshore producer, basically rebalancing its upstream portfolio to have more of what Chevron has. And then when you think about the Chevron acquisition, it's gone for ostensibly an offshore acquisition. So in fact, their upstream portfolios now are more comparable post deals than they were pre-deals. Okay. So that's interesting in itself. But not least, they're upstream producers, not refiners or chemicals, chemical manufacture, and then nothing of any note within conventional renewable energy output. So, when you say like, what would? Sorry,
I was going to say, do you want to touch on the sort of valuation differences? I haven't got any charts on it, but Exxon and Chevron, from a valuation perspective, look a lot more expensive than BP, Shell, Total in particular, and what are some of the reasons behind that?
So it's so hard to disaggregate it. And to put it in context, they started the year at twice the valuation. And they've come in quite a lot. So the way of saying that is that Europe is re-rated, or Europe, UK is re-rated relative to US derated. Why is that? I think you would have come into this start of this year and gone, this is all renewable energy output oriented, as in you were oil companies, in Europe that is, but you're spending 10-15% of your business on renewable power output, and you've set your stall out as to say you want to take 10-15% of your capital budget and put it on cost of capital return like projects, as opposed to putting it back into oil or giving it back to us. And I think
oil. So if you're BP or Shell or Chevron or Exxon, it's more profitable from a return on capital perspective to go and find more oil than to go up in wind turbines. Is that right?
Still, and that. But I think the other thing which has become apparent this year is government intervention and interference. There is, within the US at least, there is less pressure upon the majors to be delivering the energy transition in the context or the way we think about it in Europe, as in you're an energy company and your energy you provide needs to be either fossil or clean in the context of renewable power. Whereas there, it's they're leaving it up to different companies to deliver that. So there's not the same political pressure, and there's not the same interference. There's not windfall taxes. So I actually think there's probably an element of that valuation differential, which is they're just left to produce oil without government intervention, and they're doing what they should be doing, which is just drilling
for oil,
producing it, and then giving what they give out to shareholders what is not needed. And to your question on what they might do, within Europe, I mean, we've seen walking back, the non-pivot as BP did when it said we're going to let our fossil fuel output decline by 15%, and they sort of walked back from that a little bit and said we're going to invest the same, what was it? I can't remember the exact phrasing, but they basically said we're going to spend exactly the same as we were before. We're just going to spend a little bit more on one versus what we were on the other. So maybe you could see BP Shell do a renewable energy type transaction.
That would make it. Would it make more sense?
It would be consistent with what the political backdrop and the public would like, but recent actions by both companies are away from that. Most recently today, it was in the news that Shell were cutting back their low carbon energies team they were letting go of a couple of hundred of them. So recent steps would suggest they're moving.
We've got a chart on the screen to show exactly why they're doing that.
Yeah. So the chart here, which is sort of neat segue, is there's a clean energy ETF that's traded globally against what we might describe as traditional energy from pre-pandemic, and we can see that in that kind of lockdown pandemic era. Everyone was bidding significantly higher the clean energy share names, and I'm going to say that Vestas and those sorts of names are probably Ørsted, the big manufacturers of wind turbines are in the clean energy ETF, whereas traditional oil companies collapsed, and those two lines have met each other again, which is extraordinary because those renewables names have been absolutely hammered in the last 6-9 months in particular, but
part of that subsidy pricing rolling over.
I don't know.
Oil pricing.
We'd have to get a man from Schroeder on. What's his name? Mark Lacey from Schroeder. He's very good on this sort of stuff.
You've had cost of capital change, of course, and input materials have materially changed because many of these renewable energy power output companies would contract the project and the construction of the materials, but the cost of materials have gone up massively. Because
Siemens have had some sort of bailout today from the German government, the wind turbine division, 600 million euros or something, and they blamed cost inflation in that.
And that's metal, that sort of rare earth pricing, metal pricing.
No, just conventional metal pricing. And it the similarities with the oilfield services are strong in that they all were chasing projects. You sign me up and I will build you it, and then the terms and conditions associated with those contracts that they signed were poorly written, I guess is the best way of putting it. But at a bit like oilfield services were at the time in 2014, it was all work is good work, and if we can get larger order books, the share prices go up.
Yeah, too much for lands, too much. They've ordered too much.
Just
margins have gone.
Yeah, they just
Because a fund manager said to me, it was a long time ago now, but he said he saw a lot of similarities with the oil and gas industry as he saw in tobacco 15 years before.
Well, it was back in the 90s, wasn't it?
Yeah, which is essentially, we can see peak demand.
Yeah.
We know in time this product won't exist, / will certainly not exist in the same way. So supply is going to fall and fall and fall because of it, because there's not the E&P companies. You end up with much fewer players. I mean, if you look at tobacco, there's probably 3 or 4 players now, and that's it. You're sort of getting, you're a long way from it in oil. But if you think about the majors, there's no small and mid caps popping up. Actually, the small and mid caps falling over still.
But the 20 years from 96, 97, 98. British American Tobacco and Imperial Tobacco were the best performing stocks.
Absolutely,
they did 25% a year.
And I think LTIPs. I mean, you'll know better, but presumably management teams, their LTIPs are all linked to EPS. Actually, kind of the revenue growth and what they were probably looking for before, what their incentives have changed, and that's been a push from shareholders. I'm sure some of their incentive plans are around renewables as well, but I think probably shareholders have put a lot of pressure on these businesses.
But I mean, that's quite a good comp. So you can have a structurally declining industry over 20 years, and shareholders still get really well rewarded. So I don't think we need to be.
No.
BP and Shell be fine, I would think.
I mean,
for shareholders,
the alarm bells come from spend changing and that appetite, and then
buying
deals.
stuff at the top of the market.
But if they're buying deals with shares, and they're still to be a little bit hesitant about progressing and pushing ahead, and I think the threat, at least in Europe, is still quite strong around. To your point around the demand, I think the more that they get told demand is being threatened, that's probably shareholder positive in the context of the conventional energy producers, because the reinforcement of capital discipline, shareholder returns, I think, maintains them that focus, like you said, because it's so easy for them to say. I mean, people are not addicted to their product, unlike cigarettes.
No. Although I did see in Scotland there was a couple who bought a new Tesla and they'd done 7,000 miles, and the battery has blown up and it's not under warranty, because in the T&Cs of Tesla it says you can't drive it in the rain.
No way.
True story.
Right.
It's in the Aberdeen News or something.
Right.
I mean, Jamie reads it regularly.
Yeah, the Press and Journal.
The big news of the Raymond household is that we've taken delivery of an electric car.
Have you?
Yeah,
Don't drive it in the rain.
Don't drive in the rain. Right. Well, that sort of rules out winter, doesn't it? So far, very happy. But we've got this rather sort of, on clean energy and energy transition. We've got this slightly messy chart here, but I think it proves the point. If we, it's the metal and mineral requirements of the energy transition, and the top two bars here are the comparison of metals use in an electric car versus a conventional car. And if we highlight just the blue bit of the bar, which is copper, we can see that the typical electric car has twice, if not 3 times as much copper in it, as well as everything else, notably lithium, manganese, cobalt, etc., etc. And then the second part of the chart is for power generation, and offshore wind has got a very high content of metals, including zinc, copper. Copper makes sense, of course, because if you stick a wind turbine in the sea, you've got to get the power back to shore via a copper cable. Compare that to even nuclear, but particularly natural gas, which has got a very low metals content. Do you just want to sort of talk us through this and why maybe the profits to be made from energy transition is in the mining stocks? Is that?
I mean, the summary, I guess, of all to say this is that clean energy is just less energy dense, and therefore, in order to manufacture or capture, or whatever you're going to say, a joule of energy, just takes a lot more product on which to do it. But of course, it's a lot cleaner. So, I think it goes without saying that you need a significantly large amount of metal in which to manufacture any of your turbines.
And the copper price, there's a long-term chart here, the copper price. And it's not, it's gone up over time, but it's not what you'd call kind of doolally, is it? So it's some structural kind of demand drivers in the copper market, do you think?
So what's interesting about copper is that through history, it's repeatedly been shown that we'd have supply deficits, and ordinarily that the demand is met by new supply coming, and there's this sort of the ability to bring on projects often fills the gap. But that is in the traditional world of more people needing AC and building infrastructure in China, and the grid infrastructure, that sort of thing, is offset by efficiencies elsewhere.
Yeah.
But it's a different setup now, though, and it's not massive. Like if you think about global copper demand, it's like 3% growth per year. You think, what was the energy transition due to that? And you think, it's like 50 bips, maybe percent additional per year on top of it. It's not
meaningful,
transformational, but it's enough if you know what I mean.
Tip the balance.
Exactly.
And this chart here is was in an FT article from a few weeks ago. I think it was the chief exec of Freeport McMoRan, the world's biggest copper producer, gold and copper producer, talking about where is the copper going to come from. And this is a rather scary-looking chart about supply shortages in copper. Will this come to pass, or is this a bit scaremongering? And it's got the word estimate on it.
Yeah.
So anyone can estimate, can't they?
The couple of things to think about. Will we find efficiencies, other materials that could take its place? That's kind of where I think it might come from.
Is that right? But copper's.
I just feel like human race is fairly the ingenuity behind doing something more efficiently. I feel like if we've got the prospect of that, copper price is going to be 2-3 times higher than where it is today, and therefore we're going to find other metals that maybe can take that place.
The market mechanism sorts that out.
Yeah,
goes up.
I'd be shocked if we ever saw quite as severe as that. But as it stands at the moment, that's the credible. When you compound the demand growth of copper as it is needed for the energy transition, yeah, that's what it looks like.
what it
And
looks
we
like.
simply don't have the minds, because if we think back to where it was 2014 when China had its wobble, that's more or less when investment stopped into new copper supply, because all the miners had balance sheets that, well, they were like the oil companies before the oil price collapsed. They had balance sheets that were overextended. Some of them had recently done deals. So they spent the next few years sorting balance sheets and getting capital spend under control to rewrite their balance sheets, and then they've not really pushed ahead with any projects, because exactly the same as what's happening with energy now was happening then with miners. All the investors were like, please don't bring any supply on board, because we really don't want it. We've got China that's slowing at the moment. Nobody wants your metal. Stop investing, and it's a lot of money over a long period of time, and there's a hugely uncertain outlook for the demand. The difference now, of course, is that the demand, assuming we all actually participate or want to support the energy transition, because that's, of course, what's the thing that might happen. The cost of it is just too great for us willing to bear.
Yeah. Literally banging the table for copper.
I mean, to your point's correct, though, of course, is around the metal category, the characteristics of the metal copper, and for what it needs to be doing for the moving energy around in an efficient manner. It's like, it's obviously far superior than anything else. Will something come in to supplant it? I mean, that's one of the things with respect, lithium has many similar dynamics, but that could also be changed if we had solid state batteries, or we had maybe more hydrogen in the mix, as in we had some of the vehicles are hydrogen, some of them are vehicles are solid state batteries. We're not all just driving conventional lithium ion batteries.
Sure.
I feel like we could get there, but I mean, in this chart here is, you could paint very similar pictures for a number of different energy transition metals. And we spoke about OPEC a lot. We're going to have a new OPEC in the sense of where these metals are held and who refines them. And China refines them all.
Is a big player, right?
This year we had, I think, gallium export controls. Gallium, I think, is used in semiconductors.
Yes, saw that.
They've said that, and then just in the last week it was graphite. And they said, right, we're not exporting any graphite, and graphite prices have gone up. And we're going to find the same with all the other metals that they produce. And so it's mostly the smelting.
There is a geopolitics angle here, then, isn't there?
Absolutely.
And of course, China's been very clever investing.
They're way ahead of the
Africa
West.
And taking, what's it called, the Belt
and Road
initiatives.
But the government has a plan, and I've said this before, and it sort of links into Taiwan a bit, but they have a view of where they want to be, and that is economically independent in 20, 30 years. And they have the resources, and they also have the construct of society to be able to deliver that. So they want to reduce their dependence upon overseas energy. And how do they do that? Right, we domestically produce all our energy. How do we do that? We do that via renewable energy. How do we do that? Right, we build the supply chain to enable us to deliver all those things. And they've done that over the last 10 years, all the different plenary which is every 5 years they roll out the next plan of how they're going to do that with their spend and where they focus it and the regeneration, reinvestment. I mean, like, they have a plan. They're leading. Their spend that China spends on energy transition is like 2 or 3 times the US, which is number 2 behind. So they are pushing full steam ahead to try and reduce their dependence upon other countries to be able to pursue their political ambitions elsewhere.
No, there is sort of a strong geopolitical angle, and maybe us in the West have been caught a little bit short by this, and we're a little bit on the back foot, despite the efforts of the Inflation Reduction Act in the States and whatever else we're trying to implement here. So it's going to be interesting to see how it plays out. For full disclosure, we've got a few Anglo-American for clients, haven't we? Bit of Rio Tinto, we've got a bit of BP and Shell as well. So we'll see.
You've got to have diversified players, haven't you, to have exposure to this.
And we've not touched on other areas that I think are interesting, and we're both farmers' sons, so it would be interesting to have touched on the agricultural commodities and the softs and the fertiliser and that sort of stuff.
We'll have another hour.
Hughesy might have fallen asleep by then. So I think run out of time. I think we'll wrap it up. Any final points for us, Hughesy? Words of wisdom?
Not from my tap out. I have. I've thrown all my jewels in.
Good. Well, on that note, we'll thank Jamie for his time today and coming on and enlightening us all about commodity markets. Thank you for joining us, and any questions, then let me know. My email address is jonathan.raymond@quiltercheviot.com, and we hope to see you next time. Thanks very much.